This is the best trading video you are ever going to be seeing on this platform. The best video to help you become successful. In this video, we are going to be covering about 6 key factors that you need to become a successful trader. We are going to be focusing on the 3 market phases. We're going to be looking at market structure, key levels, risk management, trading psychology, and becoming a profitable trader. So follow me to the end, and if you get value from this video, like and subscribe to the channel. Also check the description box for my Telegram link so you can join my Telegram channel and receive free signals and chat setups from me on daily basis. You can also join my VIP mentorship. You can also contact me for account management and also for VIP signals on daily basis. Okay, the link my Telegram is in the description box down below this video. Now in this video I will be sharing with you everything I've gathered which will help you know and which will help you become a profitable trader. We know that in this industry most people try to make things so complicated to the point that even things that shouldn't be an issue to a trader becomes an issue. Learning trading that should not take so long begin to take long because people are taught to focus on the wrong things that don't really matter. Over the years, I've come to understand that trading is not really academics. Trading is not academics where you want to be academically correct in everything. Trading is a practical business that you need to be dynamic, you need to be able to adjust, you need to be able to adapt to the dynamics of price. So in this video I'm going to break down everything to the layman understanding and in a way that you'll be able to become profitable just by doing what I'm going to say in this video. Now, market phases, the 3 market phases. So there are 3 phases in the market. The market only moves in 3 phases. It is either going up, it is either the price is going up, or it is going down, or it is going sideways. So we have the bullish phase, which is when price is moving upwards, and then we have the bearish phase, which is when price is moving downward, and then we have the one we call bearish, sideways movement or consolidation, otherwise known as range. Okay, so these are the 3 phases in the market. So whenever you are in the market, you should have that in mind, that it is either the price is pushing up, or it is going down, or it is moving sideways. When it is moving sideways, we call it consolidation. When it is moving up, we call it uptrend. When it is going down, we call it downtrend. Okay, so it is very, very important that you know the market phase you are in. This is the first step to becoming profitable. Your ability to understand the very market phase you are in. In a bullish phase, you are expected only to buy. In a bearish phase, you are expected only to sell. Then in a consolidation phase like this, you are expected to stay away from the market. Alright, except in some occasions when you have become very competent, you might be able to trade off the bounds of support and resistance. You might be able to trade it. Okay, but in general, you are expected to stay off the consolidation phase of the sideways market. You buy the bullish phase and you sell the bearish phase. That is the first step to becoming profitable. How do you know the phase you are in? How you know the phase you are in the market is this. all you need to do is just come to the market, look at your charts and ask yourself, what has price been doing? If you look at price and you discover that price has been creating higher highs, and higher lows, just like this. You see that price has been creating higher highs and higher lows. Just know that what we are having is a bullish market. You are in the bullish phase of the market. Okay, when price begin to create higher highs and higher lows, you just know that you are in the bullish phase of the market. So in such a scenario, you are expected only to buy and not to sell. But when you see price creating lower highs and lower lows, just like this you see here, in such a scenario, you are expected to only sell. You just know that you are in a bearish market, so you should only sell. Don't go buying. All right, just sell, don't go buying. That is the first thing you need to know as a trader. All right, but in a situation whereby you see that price is trading within the same level, in such a scenario, you are expected to stay away from the market, just as we have in this place. Obviously, price has been trading relatively within the same level. In this case, you might not see a perfect setup to trade, and your stop loss will be hit easily. It is very easy for price to hit your stop loss in this kind of scenario. So it is advised that you stay away from such markets, except you have mastered the act of trading such range, because sometimes you can also trade it when price comes to area where it has been rejecting multiple times. You wait for some sort of price action and then you buy or you sell off that level. Okay, so that is the first you need to know. You have to understand your market phases. Know when you are in an uptrend, know when you are in a downtrend, know when you are in a consolidation. That is the first and number one golden rule of trading the forex market. Now, the next thing you need to know as a trader to become profitable is you have to know your market structure. So this is one of the most important things you should also know. This is your market structure, and your ability to understand how to read the market structure. That is what is going to make you profitable. So how do you read the market structure? Most times you come to the market, you see the market like this. Basically, what you are taught is that this is market structure. This is market structure. When price is going down, this is how it goes, like this. And you and I know that this is a pure lie. Price will never move in this manner, this very straightforward manner. Price will never move like this. You and I know it. Price can never move in this manner. Okay, price will never move in this manner where it's just making this plain movement. No, it doesn't happen. But this is just an illustration. Okay, so instead of this, this is what you are going to see in the market. This is what you are going to see in the market. This one that looks so confusing, this very one that looks so confusing, that is what you are going to see in the market. But I want you to understand that no matter how it looks, no matter what the market structure looks like, it is still the same principle that governs market structure. So what matters is your understanding of the principle of market structure. Okay, so it is a rule that as long as price does not break in a bullish market, as long as price does not break the lows, the external lows, long as price does not break the standard structure to the downside, it is going to continue to the upside. But when price is going up and then it now turns back and begin to break the lows of the price action, begins to break the lows, then in such a scenario, we say that price has changed direction. Okay, price has changed direction. That is what we call change of market structure, or call it change of character. Right, shift in market structure or change of character. Now, this is a typical example of market structure here. So this is how I want you to read the market structure whenever you are reading it in the market. First, you have to understand that the highest high, which is this one here, as long as it is protected, and this lowest low, okay, these two levels, they are the things that signify the integrity of a structure, right? As long as it is still protected, as long as price has not violated it, there is no break of structure and there is no shift in market structure. One of these two lines must be violated. This one above or this one below must be violated before you can say that there is a change of character or a break of structure. All right, so no matter what happens inside it, you are still in the same structure. Okay, for instance, here price came down, went up, came down, still went up again. So we see that we are still in the same structure before it came down now and then violated this low here. Then we can say that we have got a break of structure. Right now, we leave that one. We now walk away from this structure. Then we now mark the highest point that price got to during the retracement. Okay, the highest point it got to during the retracement before it started dropping, and then we mark the lowest point it got to before it started retracing. Okay, so this is it. Basically, price retraced to this point and then dropped to this point, right? After dropping to this point, it started retracing again. So this highest point and then this lowest point, those are the boundaries of this structure. They are the structural boundaries. Until price violates these boundaries, you are still in the same structure. It doesn't matter what happens, you are still in the same structure. This is what you should know. Now, some persons, we see this happen, price moves up, creates low, and then moves up, creating higher high, creating lower low like this. Then they will say we are now in a bullish trend. Just because I said that as long as if you're in a bullish market, the price will continue breaking highs and will never break the low. So because they just see this, the price is breaking the highs, they now conclude that we are in a bullish market, and so they'll begin to buy. And then after buying, you see that price will end up hitting their stop loss. This is because they were very, very unprofessional in reading their market structure. Okay, so just know that from here to this place is the structural integrity, structural boundary. Until they are violated, the structure remains intact and the trend remains intact. Okay, so whatever happens inside is what we call internal structure. This one you are seeing here is the internal structure, and it does not signify any change of character or shifts in market structure. All right, so this is what you should know about market structure. So you can see what happened there. So price pushed here, creating a high, came down, creating a higher low, pushed up again, breaking this high and creating a higher high, then dropped again. Now in this scenario, what you should wait is for price to show you a break of this level. If price breaks this level here, this level, then you know that there is a change of character. But as long as price has not broken this level, then there is no change of character. You are still waiting to sell, all right, because price is already in a bearish direction, the bearish phase. So what are you going to do? What you're going to do is this. When price continues moving, you zoom in, you scale down to a lower time frame, and then your lower time frame, you're going to wait to see price come back to this structure that you already have. Come back to this structure, and then you find your other block in that structure. Use it as your area of interest. When price gets there, then you want to go to your lower time frame and see price give you what we call change of character, internal change of character. You are now looking at the internal structure. Now price gives you change of character here in the same direction of the original trend. Remember, this thing you are seeing here is what you are going to see at the higher time frame. Then this internal structure here is what you are going to see at the lower time frame. So when price gives you this change of internal structure, then you also mark out the other block again. Okay, when you mark it out, then as price returns to it, that is where you take your sell. That is how trading works. So you don't just because you see price going up here, then now you come to buy. So you wait here saying this is another block here, price has given you a break of structure here and here. So this is another block, then you want to buy. This is what most people do again and again. So you just come here, mark here that there's another block here, or it's your supply level, then you take a buy. This is what most people do. Then you now click here and then take a buy. So this is what most people do. Then you come here, take a buy because you believe there's another block here. You saw another block here. So you come here, take a buy, and then price comes here and then pierces through your stop loss. And you lose. You keep wondering what happens. Like you obey the rules of the market, you follow market structure, and you still lost. But it's because you are following market structure in the wrong context. This was just a pullback, retracement, and here the pullback has finished. So you were trading against the trend. It was counter trend trading. Alright. So in this scenario, you should have waited for this to happen, being a change of character. Then you wait for price to now come here. So you take this trade here, take the trade of the other block in this region. Use the other block in this region for your entry. Alright, and then this is how you become profitable over time. When you keep doing this again and again, over time you find yourself becoming profitable. Like I said, this is the best principle, and then you target this blue here. This is the principle of trading. That's how trading works. This is how trading works. You need to understand this principle. It's very, very crucial you understand it. Alright, so you wait for this to happen and then you take your trade. That's why most times we use our trend line just to give things, more meaning. You can see when we use our trend line, most times this is how it is. We use our trend line and then wait for a break of trend line and structure, and then wait for a retest, and that's it. You are making profit. Okay, so this is it. Now this structure at this point has been broken also. You can see at this point this structure has been broken here. So since structure has been broken, then our attention will now shift again. Our attention will now shift to this high that started the move to the down. This is the highest point price got retraced to before dropping, and then this is the lowest point it dropped to before another retracement. So this is our new structure. Do you see how we are moving it? Do you see how we are reading the structure, market structure? So you shouldn't make the mistake of seeing this high as your structural level. No, it is this high which is the highest point of the retracement. That is your structural boundary. Okay, now this one here is the structural boundary also in the direction. So if price breaks above here, we have change of character, which means price is now going to be moving upward. But if it breaks this below, then it is still continuing in the same direction. So how do you take trade here? You can see how price did this here. At this point, price created price started creating highs, low, higher high, higher low here. But at this point, it created lower low, came here, created equal low. You can see, went here, created equal high again. So at this point, probably someone will enter here again. Seeing another block here, enter here, then you place your stop loss here. And then price drops to this point and goes back, clears your stop loss, and then comes to use another block that is here. This is the liquidity sweep that we talk about. This is the price uses you as a liquidity, and then after this it drops. So what you fail to understand is that whatever price was doing here, it was still within the same structure. Okay, it was still within the same structure. Now you will feel like you use market structure and you still lost, which means market structure doesn't really work. But that's not the truth. Market structure works. It's just that sometimes you make mistake, you won't see what the market is saying. Most times when price gives you equal high like this and then creates another block above it like this, most times it's going to sweep this high and then come back to use this other block. Alright, and any other block that was here wouldn't have been valid, basically because there was no break of structure here. Alright, and there was none here also. So most times it will come here or somewhere here. Alright, because there's a break of structure here, internal break of structure. So it will sweep these ones, liquidate everybody that took trade, took sell here, and then come here to this point before reversing. That is what we see every day in the market. So follow this simple principle. Alright, understand how the price moves, understand how it makes its structures, and trade in line with the trend. Now let's see the next concept, which is key levels. The third one, which is key levels. Now when we talk about key levels, we're talking about areas of support and resistance. Areas of support and resistance. When you are trading and you see that price concentrates its action on a spot for a long time. For instance, you have something like this. Price moves. Okay, so price concentrates its action on a particular spot for a long time. Maybe price moves like this, and then around this area price consolidated and then breaks like this, breaks. So you see that this area where price consolidated like this will become your support area. Okay, here will become your support area. So next time you expect price to go there and drop. So as it goes there, this place turns, as price breaks it and goes there, here turns to resistance. Right, it turns into resistance. So you must understand this. It turns to resistance, and most likely price is going to reverse from here and continue dropping down. All right, so you must understand how to identify this stuff in the market, because it is a concept that is going to help you become profitable a lot in the market. It is a concept that is going to help you become profitable a lot in the market. Now look at this here. A typical example is this. Price came here to this level. Price came to this level, and then you can see, and was rejecting again and again. So at this point, price rejected. At this point it rejected. At this point it rejected. At this point the same. So eventually price broke it and went up to this point. And then when it came back, it used this place that was a resistance. It now used it as a support, and that is how it pushed up like this. So this is what you must understand. When you have this understanding, you are able to increase your trading success. You are able to increase your win rate. Okay, so understand your key levels. Look at it here. At this point also, price also consolidated for a while. Eventually it broke it. When it broke, it had to pull back, retest, and then drop. Also, that is just how this whole thing works. Then you can also see that at this point, price did the same thing. It consolidated here for a while. This is it. You can see, this is what happens every day in the market. So price consolidated for a while. At this point rejected, at this point rejected, 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 rejected. Eventually price broke above it and then came back. Now this was a resistance, right? Now it came back, used it as a support, formed this double bottom and then pushed up just like that. Imagine you understanding this concept of key levels. At this point, when price broke this level and came back to the test, you would have hopped into this trade and then you buy and make a lot of money up to this point. So this is the concept of key levels. This is very, very important. This works on all pairs. It works on all instruments. What I'm teaching you now applies to currency pairs, applies to synthetic indices, it applies to stocks, it applies to crypto. Okay, whatever you trade, futures and sports, it applies to all of them, whatever it is that you are trading. So that is why you must understand it and you must take it seriously if you want to advance your trading career. Okay, so you can see this one. Price has also been reversing from the same level, and eventually when it gave us this bullish and this bearish engulfing pattern here, you can see this big bearish engulfing pattern here. Once it gave us, it dropped. Okay, it just dropped massively. So that is the impact of key level. As it was rejecting from here, this place automatically became our resistance level. And if you trace it back, you can see that is our resistance level. At this point, price had also rejected within the same level. This is it at this point. So no wonder it became this. You can see price rejected here. So at this point, price rejected again. So it is our resistance level, just like that. And with this simple knowledge, you're already cashing out, you're already becoming profitable in the market. The same thing happened here. You can see how price rejected here multiple times. Is it? And then you can see when price came back there again, when price returned there, you can see what happened. And see what happened? Dropped massively. This is the importance of key levels. Guys, you must understand key levels. You must. It is a must. You should understand it because these are the basic principles. This is the market sentiment. Whenever something happens in the market, whenever price finds it difficult to break through a certain level, next time it comes there, it is also going to experience some difficulty and might turn back from it. You can see the same thing happening here. Price had some difficulty breaking here, tested here, pushed up, came back, tested, pushed up, and eventually it broke it. When it came back, gave us a kind of double top. You can see, gave us double top. Yeah, double top here. This is the first top, and this is the second top. After it gave us that, it quickly dropped massively, and this you would have sold and made a profit. Okay, so guys, understand key levels. Just go to your chart, backtest this whole thing I'm teaching you, and believe me, your change will just begin immediately. You are going to see how you are going to have massive change, massive improvement and profitability in no time. Now, the next thing we are going to look at is risk management. Risk management is very, very important in trading. Risk management is key. There is nothing you are going to do in this business that you will never have a losing trade again. No, you are still going to have losing trade at some point, even though it will be minimal. But the thing here is that you want to minimize your risk in such a way that if you have $100 account, you will not just trade one opportunity and blow it. Rather, you will be able to try like 5 times before blowing the account, even if you are always wrong. At least to be able to try like 5 to 10 times before blowing the account. So it is dependent on how you manage your risk. For instance, this is a key level here. So price has broken out of here. Price has broken out of this resistance level here. Price has broken out, came back to retest. So if I'm going to take this trade, what I'm going to do is I'm going to place this here. This is my entry. Then I'm going to say, okay, in this trade, I want to risk only. I have an account of $100. I want to risk only $10. Right? I want to risk only $10 on this account, which means if I blow it, I will have to blow my account. I will have to like lose 10 trades in a row before blowing the account, which is going to be very, very difficult to happen. Okay, so you see that I have the chance of survival. I have huge chance of survival. So here I take a trade of 1:2 risk reward ratio. All right, 1:2. That's what I'm going to go for. 1:2. Now you see that price eventually went to my take profit like this. So I have made $20. I risked $10 on this trade. Remember, I risked $10 on this trade, and now I've made $20. So my account balance will now be 120. Okay, so but in a situation whereby you tried trading and you lost it, what will happen? You will still have the opportunity to try again because you managed your risk properly. Imagine you have $5,000. You should be able to know a particular percentage of that account you are willing to risk. You have $5,000. You may decide to risk $100 per trade. Now, if you are risking $100 per trade, 100 times 10 is going to give you 100 times 10 is going to give you 1,000, right? It's going to give you $1,000. Now it's going to give you $1,000. 100 times 10, but 100, which means 100 times 50 is what is going to give you $5,000. So for you to blow this $5,000 account, if you are risking $100 per trade, for you to blow this $5,000 account, you have to lose back 50 times back to back, and that is going to be almost impossible, because for you to lose 50 times back to back, man, that is crazy. That means you don't even know what you're doing. All right, so you can see you have $1,000 account and you only risk $100. If you lose this $100, you are going to have 900 left. Okay, so for you to blow this account, you have to say $100 times 10. All right, $100 times 10. That's what it's going to give you, $1,000. So you have to try 10 times. You have 10 opportunities to try, and believe me, you can't always be unlucky. There's no way you are going to try 10 times and then lose consecutively, except you are not following the rule, except you are not keeping this risk management. But as long as you are keeping this risk management and you are only following market trend, like you are following the phase of the market, you are using the market structure, and you are using key level, you put this trade major knowledge together: market phase, market structure, and key levels. You put these three concepts together, these three knowledge together, because you are following them strictly. Believe me, as long as you add risk management to it, there's no way you are going to lose 10 times consecutively. It is practically impossible. So with this, you are 50% sure of at least breaking even. You're at least sure of having a break even if you're not going to have profit. You're sure of having break even. And then with a little more, mastery, a little more refining of your strategy, you are most likely going to have 60 to 90% win rate. All right, you're likely going to have 60 to 90% win rate with this simple concept I've taught you. All right, that is why risk management is highly important. Risk management is very, very important. You cannot ignore risk management if you want to play this game long enough. If you want to make living from this game, you cannot ignore risk management. All right, now let's go to the next one, which is your trading psychology. Trading psychology. I've talked about risk management. Now I'm trading psychology. Now, what is trading psychology? Now, I used to tell people that trading is, you have three things in trading, right? You have the trading skill, which is like your technical analysis. You have your technical analysis, you have technical skill. The next one is your risk management. And then the last one is your trading psychology. Psychology. Yeah. So these are the three things. These are the three skills you must master. The three things you must deal with very well before you can say you are a trader. Trading technical analysis, risk management, and then trading psychology. You must deal with this. You must master these things before you become profitable in the market. Okay, so your technical analysis is the things I've taught you: your key levels, your market phase, and your market structure. These ones are your key levels, your candlestick patterns, your chart patterns. Those are your technical analysis. You must master that skill very well. The next one is your risk management, which I've talked about. You must master your risk and money management, how to manage your money in the market so that one mistake will not wipe you away from the market. The next one is your trading psychology. Now, what is your trading psychology? We all know that trading is a game of the mind. If you don't know this, then you are yet to begin. You are not ready for profits already. You are yet unprepared to become profitable. Trading is 80% mind game. It is a mind game, all right? You are competing with some of the smartest persons on earth. You are competing with some of the smartest persons on earth, all right? And another thing to note that is that some of these persons, they have larger funds than you do. Some of these institutions, they have like very huge funds compared to what you have. So you are competing with people that are at a better advantage than you. They have better advantage than you do. So it is more of a mind game. You must find a way to outsmart them so they can take their own money. Because it is anybody that makes mistake in the market, that person becomes the liquidity of the market. The market runs on liquidity. This chart you are seeing here is running on liquidity. So those that make mistake will become the liquidity of the market. If you snooze, you lose. If you heard that one, let me see you write it in the comment box below. If you snooze, you lose. So that is what happens in the market. Now, if you don't know how to control your mind, you don't know how to control your emotion, you find yourself falling victim of liquidation every time. Now, when you are making profits, there's every tendency that you become excited. There's every tendency that you become excited and you start leveraging more. You will start increasing your lot size. You start holding your trade longer because you are making profits. Now, this kind of euphoria, this kind of excitement don't usually end well. You start trading carelessly, and most times it doesn't end well. It makes you vulnerable, and the market end up giving you a very fatal blow. So you must watch your emotion whenever you are winning trades. Then the next one is when you are losing trades, you become fearful, you become very anxious, you become very scared of the market. So you have a lot of skepticism, you become skeptical. So you see opportunity, you see a very nice setup, you will not be able to enter it because you are afraid. You miss that opportunity. And that would have been an opportunity that would have given you a very nice profit. You miss it because of fear. You've lost before, now you are very skeptical of taking another trade. You are now beginning to doubt yourself. You don't believe in your strategy again. That is fear. That is a very bad state of mind. It's a very bad trading psychology. So whenever you notice this fear in you, whenever you see yourself losing 1, 2 to 3 trades in a row, you just close your chart and leave the market. Walk away. That is what you do. You just close your chart and walk away. Now the next one is greed, which is what I've talked about. At some point, you find yourself becoming greedy in the market. You are someone that used to be happy when you make $5. You're someone that used to be happy when you make $10, $20. Now, even when you have $50, $100, you are not satisfied. You still want it to get to $500, $1,000. And before you know it, price will reverse. Something that had given you $100 will now reverse and hit your stop loss. Again, and hit your stop loss. If you have experienced that before, let me know in the comment box below. I have had that experience. So you must control your greed. You must watch your greed. Whenever you see that you are becoming greedy, just close the chart, walk away. When you feel normal again, come back and continue. The market is always there for you. Alright? So make sure you watch the state of your heart whenever you are trading. If you know that you are having dizziness, just close your chart and go and sleep and rest. Alright. So that is it about markets, about trading psychology. Now the next one is becoming profitable. This is a very important one because you have to find a way to become profitable in the market. Very, very important. You have to find a way to become profitable in the market. Now, how do you become profitable? It is by finding a strategy that is going to work for you. Make sure you look for a strategy. I personally trade the break and retest strategy, as you guys know already. I trade the break and retest strategy. That is what works for me. So I found a way to refine it. I can use the trend line. I can use market structure, just normal market structure. I can use my support and resistance. I can use the channel. So when price breaks out of any of these levels, when price breaks out of my trend line and goes back to the test, I can take my trade. When price breaks out of my market structure and goes back to the test, I can take my trade. Just like this one here, and then price breaks out of this structure as we have here. Price breaks out of this structure and then comes back to the test, as you can see here. Then this could be an opportunity for me to sell and make decent profit. So this is it, and then my stop loss will be above this high. This is it. Very simple. Okay, so and then I just continue to modify it and just continue to improve on it, just to make sure that I increase my profitability. That is how the business works. Become profitable by working on your strategy. Find a strategy that implements these three concepts I've given you. Number one is your market phases, a strategy that aligns with the market phase. Then secondly, the market structure. And then thirdly, the key levels. A strategy that takes note of these three important factors in the market will always work well. And then you add it up, you spice it up with risk management and proper trading psychology. Believe me, you are 100% set for profitability. The only thing you are going to do is that you try to keep improving on it, keep practicing it, keep back testing, keep forward testing, and keep using your simulation testing, simulation trading, like your demo account, your play mode on trading view. Just keep using all those stuff, back test again and again, and you see how you'll be improving on daily basis. All right, so this is just what you do to become profitable. If you want to learn more on this, if you like what you just got and you want me to mentor you, check the description box of this video. You're going to see a link to my Telegram channel. Contact me for mentorship, and I'm going to take my time to teach you how to become profitable in a very short time and the quickest time possible. All right, so this is the Alpha Trade, and as we always say, it can only get better. I'll be ending this video here. Check the description box, click the Telegram link, and join my Telegram. Make sure you subscribe to this video if you are new, and then like this video and share to your friends. Okay, turn on the post notification bell so whenever I drop a new video you get notified. Thank you guys for watching. Bye.